So if you hadn't realized, there's something going on this week, the merge. It's due to take place, well, somewhere around tomorrow, or if you're in the Euro time zone, slightly after that. But it's a big deal, and what it will mean is that you, dear humble viewer, as a humble owner of a little piece of ETH, you can participate in the ETH network and earn rewards. Yes, big, fat, juicy rewards for doing so. And in this video, we're going to look into exactly how you can do that, the different methods you can use, and all of that coming up straight after this. Platforms that ensure the safety of their clients' funds will help build trust in the crypto space. That's why Nexo is setting an example by putting security first and making sure that over 4 million customers have instant access to their funds all the time. On Nexo, you can buy crypto and automatically start earning daily interest. Use the exchange to restructure your portfolio in seconds while getting rewards on every swap. You can also get instant liquidity without selling. Simply borrow against your crypto at rates as low as 0%. Visit nexo.io and find out for yourself if that's the right place for your crypto. BitRefill allows you to shop online and physically without banks, converting your crypto into merchant balance directly without any sign-up. It offers more than 5,000 gift card options in 180 countries, and in the USA, you can now pay bills like your mortgage or credit card. Creating a BitRefill account is not required, but it only takes 1 minute, and you can get 1% back in rewards. When you shop for plane tickets, you probably use Kayak, Expedia, or Google Flights. So why would you limit yourself to just one exchange when you trade crypto? To make sure you're getting the best possible price, you should use a DEX aggregator like Matcha. Matcha routes your orders across all the various DeFi exchanges on Ethereum, Polygon, Avalanche, BSC, Phantom, CeLo, and Optimism to provide the best possible prices without taking any commissions. Matcha has integrated fiat on-ramps so you can buy directly with your credit or debit card, and uses smart order routing that splits your order across multiple liquidity sources. With Matcha, you can make limit orders on chain so you can set and forget your DeFi trades, and now Matcha even offers gasless trading. Head over to matcha.xyz/Defiant and connect your wallet to start smarter with Matcha. So the excitement is ramping up, and for obvious reasons. Some of us think that the merge will be a bit of a non-event, and some, like our good friends at Bankless, believe it will be the biggest event in their short history. And good for them. We need people on both sides of the argument here, and maybe the argument needs to stop. But anyway, we can look at this little merge countdown clock here, and right now, where I am, 1 day, 20 hours, and 50 minutes. I'm recording this around 11 o'clock in the CET time zone, and so that will put us somewhere on Thursday morning, which is really exciting, isn't it? Well, hey, look, let's look into the exciting stuff around this. Proof of stake. This is the big story here. We're moving from proof of work to proof of stake. No longer will the network be secured by miners, but by validators instead. It's a whole different story. So proof of stake is a cryptocurrency consensus mechanism that's used to validate transactions through randomly selected validators. Validators stake crypto, and that serves as an economic incentive for them to act in the best interests of the network. So you balance those incentives and you reward them for doing so. And they get rewarded in the native token of the network, in this case, ETH. And if you believe in the value of the ETH network, then acquiring more ETH is good for you. It makes economic sense. And what do you have to do to validate on the Ethereum network? Well, you need 32 of the Queen's ETH to do so, which is a lot, actually. It's a lot. So here's some of the different ways we can stake on Ethereum. First one is this concept of liquid staking. So when you stake on the Ethereum network, your tokens are locked up. Now, since the Beacon chain was launched, tokens have been locked up with no way of coming back. So you convert ETH into ETH 2.0, and then it's just there, and it's earning rewards, great, but you can't withdraw it. That will still be the case post-merge, because there's another update that has to come before tokens can be withdrawn. And it won't just be like you can suddenly just take out all your money from the bank. Not at all. It'll be quite restrictive. And even if you're just staking nakedly to the network, there will still be a period in which you can unstake, and it just won't be an instant withdrawal. So what liquid staking does is it says, here's your token. We're going to give you a token that represents that token or your position in ETH, and then allow you to do whatever you want with it. It will be liquid. So Lido is the most famous of these. Lido popped up, well, quite a long time ago now, and people were using it as a means of earning staked ETH rewards, but without having the pain of the lockup. And if you remember a little earlier in the year, it formed a big part of the Three Arrows Capital narrative. We'll get back into that in a second. But the big liquid staking operations are Lido and Rocket Pool. Lido currently offering around 3.8% APR on staked ETH, and Rocket Pool 3.61% on RETH, which is their version of a derivative of this. So let's have a look at Rocket Pool. All right, let's look at the clock on the Ethereum merge. So 1 day, 23 hours and 53 minutes. It's actually changed. It's gone up. So things are slowing down a little bit. So roughly 2 days, 1 day, 2 days, 1 day, maybe tomorrow, maybe Thursday. We shall see, but very soon nonetheless. So here's Rocket Pool. There is at the moment $7 billion worth of ETH staked there, and the APR is 3.8%. So if you want to stake there, you just click on Stake Now. You connect your wallet, put your ETH in, and you're off to the races. Rocket Pool, let's have a look. You can stake and run a node, but we're not going to look at that, even though that's 4.83% APR. You only need 16 ETH for doing that, which is obviously less than the 32 ETH you need to run a full solo node. And then here, simply, you can just stake ETH 3.61% APR. And that's all fine and dandy. So why would you go this route? Well, firstly, the advantages are you have a liquid token that you can do things with, and you can sell it as well. You can trade it, and you can use it in different DeFi protocols. And here's one that might be of interest. So this is a Yearn vault. It's the Curve ETH vault, and it's paying out an APY of 7.49%. We'll get into how it's able to pay that out. But don't forget that this is on top of the 3.8% you already have. So you're getting around 11 or so percent in APY for holding ETH, bear in mind, for holding ETH. That's pretty good, all in all. But of course, there are some risks involved in all of that. Let's just go and have a look at that now. Here's the Yearn vault, and we can see here that the strategy is using Convex. So it supplies CRV to Convex to earn CRV and CVX. And then those earned tokens are harvested and sold for more CRV, which is deposited back into the strategy. So it compounds and gets you to this APY of 7.49%. Very nice. Now, what are the risks involved in this? Well, here's a chart of what happened when staked ETH depegged from ETH. Now, this is a bit of a misleading term because it's not actually pegged. It's the market that decides what the discounted price of staked ETH to ETH should be, or the premium that you should pay when it goes above. And this is simply reflecting the market's appetite for the staked ETH token, the risk it thinks there is implied in that, and the premium on the rewards that are being paid out to staked ETH holders. So technically, if staked ETH is trading at a price lower than a 1-to-1 ratio with ETH, this gap here should reflect the market's confidence in the staking rewards. And it should, if you add the staking rewards, bring it all the way back up to here. But of course, this is a free market. It can do whatever it wants. And down here, it went all the way down as low as 0.94 ETH for a staked ETH. So this was a great time to be buying staked ETH because basically you were buying an advanced IOU on an ETH token, and then you were getting the rewards as well. But obviously, this is kind of just markets doing what markets do. So the risk involved here, because you're depositing funds in a smart contract, there could be a bug, it could be exploited, and of course, it's not actually pegged, it's a derivative. And so you may end up with a situation in which you need to sell your staked ETH and you want to get back ETH, but you'll be getting back less ETH than you put in to begin with. So that's the risk that you take. It's a market. There you go. So the other thing you can do is you can stake on exchanges, and we have Macaulay Culkin screaming and running away here because, as we know, centralized exchanges bring their own risks. But Coinbase is offering 3.25%, and if we compare that with Lido, which was 3.8%, and Rocket Pool with 3.61%, it's competitive, not quite the same. Kraken is offering 4 to 7%, Crypto.com offering up to 6%, and Binance offering up to 5%. 5.2%. So Coinbase is the only one offering a fixed return. The others are variable. And of course, the risk with an exchange is these are not your keys, therefore not your coins. So let's have a look at these. So here's where you will find the Coinbase staking rewards. It's on the Earn page. And there's other tokens that you can stake here as well. Cardano, Tether, Solana, Cosmos, Algorand, Tezos. But here's Ethereum 2. And that'll give you a 3.25% APY. You just select that. Say how much ETH you want to deposit, and off you go. Here's the Kraken page. It's on staking coins, and then again, you can stake a whole bunch of different ones. And we just need to find Ethereum. There it is, 4 to 7%, subject to additional terms and conditions. Always read those. Crypto.com, ETH up to 6%. There should be an asterisk there as well. And then Binance, ETH 2.0 staking up to 5.2%. And there's other ETH products there as well, but this one up to 5.2%. And if we look on the information here, it's adjusted daily based on the on-chain staking rewards. So those are pretty constant at the moment, but everyone's expecting the on-chain rewards to dramatically change post-merge. So that's something to bear in mind. But of course, the biggest risk with these exchanges is something could happen. You have a Mt. Gox moment, you have a Quadriga moment where suddenly just something happens and it's all gone. That can happen because it has happened. And therefore, even if you think that these exchanges are very strong and very reliable, it's still a risk. Now, staking pools are another way that you could contribute. So ETH requires 32 ETH to run a validator, as we already said. But independent staking pools, well, they offer an alternative for you to deposit a smaller fraction of ETH and still enjoy some of those rewards. And some of the biggest ones are Everstake and Stakefish. I had a look at those today. Stakefish has sunsetted its fractional staking service. So at the moment, it's only offering the opportunity to put in 32 ETH. And this is quite interesting. So the calculator here, if you stake 32 ETH for a period of a year, you get back 2.13 ETH in total, which doesn't sound like that much. But of course, if you're not really intending to do anything with it, coming back, you put in 32 ETH, you come out with 34 ETH. If, for instance, ETH goes, as we think it might do, it's up to $10,000 at some point, then you've earned yourself 20 grand. But of course, with staking rewards, things never really work out the way you think. It's not like passive income where you get like a similar amount every month. Staking rewards really only work if you get in early when the market is bad, you hold for a significant period of time, and then you sell when the market is good. Historically, that has been the best way to earn from staking. It's very much a seasonal adventure. Here's Everstake. We're going to be able to delegate ETH 2.0, and that's coming soon. So we're not seeing anything yet, but here's the important bit. Our fee, 10%, the yield, 4.05%. And the reason you would do this is it's an independent pool. It's pretty well established, pretty well trusted. But again, there are risks involved in independent pools. For obvious reasons, they might just up and rug you because these things, again, they can happen. So what else can you do? Well, you can be a solo validator, and that means you put in 32 ETH, you run a node. So this is the page on Ethereum. At the moment, there's 14,410,797 ETH staked and a total of 426,181 validators. So the current APR at the moment is 4.1%. The predictions that I've seen seem to suggest that those rewards will go up towards around 8% APR. And that gets really interesting. I don't know why that's going to happen and how those numbers have come about. But again, I will be watching with great interest the first kind of couple of days after the merge to see what happens to those staking rewards and how much money pours into ETH if those rewards are there. But of course, the more stakers there are, the more validators there are, the less likely it is that you're going to get the reward. And yeah, well, let's see what happens there. So they go through a few different ways that you can do this solo home staking. You will need a dedicated computer, 32 ETH, and you'll have to be connected to the internet 24/7. There is basically, when you're running a solo node as a validator, there's a burden on you for uptime. So you have to keep the node running, and it requires you to know, some to get into the command line of your computer and type in some code. It should be a lot easier than it used to be, but I used to run a node for Harmony, and there was a lot of kind of flapping about. When they change the software or you have to reboot the network, you have to make sure that you get your node up and running again very, very quickly. It's a pain in the butt. Honestly, it's a pain in the butt. So that's why you can do things like staking as a service, where you entrust your node operation to a third party and you just give them 32 ETH and they will take care of the hardware side of things. And again, there's counterparty risk involved on that. I had a look at some services that do this. I found this one, but again, I wasn't really entirely sure of the validity of this. Normally when you run a search like this, you can find the top 2 services that are pretty well trusted and have a lot of people entrusting their tokens to them. But I couldn't find a lot with staking as a service, the SaaS version of this equation. So that's basically it. There are lots of different ways for you, if you have a large holding of ETH, you have a small holding of ETH, to participate in this network, which was never there before when ETH was a proof of work network. What this should mean is a greater level of decentralization. And of course, a whole bunch of other things will come off the back of it, using this return on staked ETH to create new financial products. All of that's to come, and I'm sure there are lots of people building those products at the moment. But really, the merge completely changes the narrative for ETH. And when people get excited about it, I understand it. When narratives change like this, it changes the whole dynamic of what a network can look like. And that is definitely a reason to look at it with interest. I hope that was helpful for today. If you have any suggestions for me to cover in a tutorial, please do drop them in the comments below. And as always, stay safe out there. This is going to be a volatile market as this merge event approaches, so stay safe. I'll see you on the next one. Peace!